Most people think tax increases happen when Congress passes new laws. But what if I told you that some taxes in retirement go up every single year without any new legislation? It's true. And if you're retired or planning for retirement, you could be paying more in taxes than you expected, simply because of how these rules were written decades ago. And these aren't new taxes. They've been there for years. In fact, 12 years or more in the 4 examples that we're going to discuss, quietly affecting more and more retirees as time goes on. Today, I'm going to walk you through 4 sneaky taxes that can take a bigger bite out of your retirement savings over time. And sneaky tax number 3, well, that's extra sneaky because it's a tax that kicks in just because you got a year older, even if your income stays exactly the same. So be sure to stick around for that one. All right, let's dive in. Sneaky tax number 1, Social Security taxation. Social Security is the cornerstone of retirement planning, so that's a great place to start. Originally, benefits actually weren't taxed at all, but in 1983, Congress introduced taxes on Social Security benefits for high-income retirees only. Well, here's the problem. The income limits have not changed since 1983. If your combined income, meaning your modified adjusted gross income plus half of your Social Security, exceeds $32,000 for married couples or $25,000 for single filers, you start to pay taxes on your Social Security benefits. Now, if your income goes over $44,000 for married couples or $34,000 for single filers, you max out the taxability of Social Security. Up to 85% of your benefits would be taxable. Now, here's why that tax is sneaky. Back in 1983, a $44,000 income was a princely sum. It actually put you in the top 10% of all earners in retirement. It was specifically for high-income retirees. But today, more than half of all retirees pay this tax. It's because the limits were never adjusted for inflation. A tax that was meant for high earners now affects the majority of retirees. And unless Congress steps in and changes these rules, this tax will hit more and more people every single year. Now let's talk about another tax rule that's been frozen in time since the 1970s. And that's sneaky tax number 2, the capital loss deduction limit. Now, if you've ever had a bad investment year, you probably know that the IRS lets you deduct losses from your gains. But what happens if your losses exceed your gains? Well, they've got a plan for that. You can deduct $3,000 per year against your ordinary income, but only $3,000 per year. And that limit was set in 1978 and has never been adjusted for inflation. Now, if it had been adjusted for inflation or indexed for inflation, that deduction today would be somewhere close to $13,000 per year. But it's not. It's frozen in time at $3,000 per year. And here's why that's a problem. Let's say you've got a $100,000 loss in any given year. Because of this outdated limit, it would take you over 30 years to fully deduct all that loss. And for retirees, that's simply not practical. When this rule was created, portfolios were just simply much smaller, and $3,000 went a lot further. Today, it barely makes a dent. So let's move on to sneaky tax number 3, because this one gets even stranger. Your costs can go up not because your income increased, but just because you made the mistake of having another birthday. Sneaky tax number 3 is, of course, Medicare IRMAA. Now, sneaky tax number 3 is the one that kicks in just because you turn 63, even if your income stays exactly the same. Now, we all know that Medicare isn't free, but most retirees expect to pay the standard premium for Part B. But what many people don't realize is that if your income is too high, Medicare charges you more. It's called IRMAA, the Income-Related Monthly Adjustment Amount. And here's where it gets sneaky. IRMAA is based on your income from 2 years ago. That means if you had a high income year at age 63, you might not realize you're going to pay more, sometimes a lot more, when you turn 65 and start Medicare. Now, even if your income drops later, you're still stuck paying higher Medicare premiums until IRMAA adjusts when you file an appeal or a new tax return replaces your old tax return. So let's break down some of those numbers. If your income exceeds $212,000 for married couples or $106,000 for single filers, you start paying IRMAA surcharges. And these aren't small increases. Depending on your income, Medicare could cost you thousands more per year. This tax is especially sneaky because your income didn't change, you just made the drastic mistake of turning 63. Now let's talk about the last sneaky tax, which affects investors and married couples in particular, and that's sneaky tax number 4, Net Investment Income Tax, or NIIT. This tax is sneaky because your income doesn't change, you simply got married. If you've got investment income, things like dividends or rental income or capital gains, you might be subject to the net investment income tax. This is an extra 3.8% tax that applies when your income exceeds a certain threshold. And here's what makes it sneaky. That threshold has never been adjusted for inflation. The tax applies when your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples. Now, these numbers were set way back in 2013 and they have not been changed since. If they had been adjusted for inflation, we might be somewhere closer to $275,000 or even $350,000 today, but they're not. They've been frozen in place for well over a decade. And if you're married, you don't even get to double the limit. This is what makes it extra sneaky. Many other areas of retirement planning, like marginal income tax brackets, the standard deduction, or IRMAA brackets, you get significantly more, double or nearly double, when your household goes from one person to two people when you get married. Well, not net investment income tax. You only get an additional $50,000 of additional room for income. A single filer can earn up to $200,000 before paying this tax, but a married couple only gets a combined $250,000. So 2 working professionals can get hit by this tax just by getting married. So there you have it, 4 sneaky taxes that can increase how much you owe every single year, even though no new laws were passed. And these taxes will continue to affect more retirees as time goes on, and inflation continues to shrink this group exempt from these taxes. So which of those sneaky taxes surprised you the most? Let me know in the comments. And if this video helped to make your retirement even better, hit the like button, and that's going to help you find my next video when we publish it. We'll see you in the next one.